When it comes to the financial analysis of income properties, many people are intimidated. They often think it's too difficult, and so they refuse to even try. The truth, however, is far from this. Many of the calculations are very straightforward and can be carried out on the back of an envelope. Let's show you how simple it is to determine whether you should pursue the acquisition of a given income property or not, given a specific purchase price. The first calculation we will demonstrate is the capitalization rate, or cap rate for short. The cap rate is calculated as the net operating income produced by a property divided by the purchase price, and helps us to determine whether the property is priced too high or too low. But then your question to us will probably be, how do we determine what is the right cap rate for an income property? Well, the answer to this question is based on the type of property you're thinking of purchasing. For example, if you're purchasing an apartment building in Toronto that's located in a high-demand neighborhood with medium to high income tenants, then the cap rate will probably be lower, say 5.5%. On the other hand, if we're looking at a lower demand area with a lower income tenant profile, then the cap rate will be higher, say 6.5%. As you can see, a cap rate will go up as demand decreases. The risk is higher, and there are more unknown variables in that specific location, such as deferred maintenance. The opposite is also true. As demand increases, risk decreases and more variables are known or predictable. Therefore, cap rates will decrease. There are other factors affecting cap rates as well, such as interest rates and economic conditions, but these go beyond the scope of today's topic. In general, current cap rates for a given area can be determined from recent sales as well as online. Several sources publish updated cap rates for various locations across Canada. You will then have to adjust these cap rates based on the demand, risk, and predictability factors discussed earlier. Let's move on to the second element of the formula, which is called the net operating income, or NOI for short. What is the property's NOI? It's the total annual revenues, which include rental income, laundry income, parking, etc., minus annual vacancy and annual operating expenses. Operating expenses may include taxes, insurance, utilities, and so on. Let's try an example. You are interested in buying a building that generates a total of $140,000 in revenues per year. You have determined that the annual operating expenses are $70,000. Therefore, the net operating income is $70,000. Based on your research, you feel that the right cap rate for the area is 7%. You can now conclude that a fair purchase price is $70,000 divided by 7%, which will give you a price of $1 million. This is one very simple and straightforward method for determining the value or purchase price of a building. It is crucial that you are very careful to obtain all relevant and accurate information from the vendor, as this information will be used in your cap rate calculation. Getting accurate information from the seller is the key. Now you have the tools to determine the right purchase price for a property. It wasn't that hard, was it?